So, ladies and gentlemen, my name is Devanshi and I will be your MC today. Good evening and welcome to the WebEx session COVID Finding Opportunities and Designing Structures for Investing in India. The session is being presented by Nishchal Joshipura, Vaibhav Parikh, Kishore Joshi, and Prashant Prakhar. Please note that this session will be in listen only mode and will last for about 60 minutes, of which the first 30 to 40 minutes will be spent on panel discussion. The remaining time will be available for question and answers. We request all our participants to post their questions in the chat window. The moderator will queue up the questions for the speakers accordingly. I request you to keep writing the questions while the panel discussion is on. Should you need any assistance during the conference call, please use the chat option. You may note that this conference is being recorded. I now welcome our session presenter, Nishchal Joshipura, who co-heads the corporate practice and specializes in advising private equity funds and MNCs for their investments and acquisitions in India. The other panelists are Vaibhav Parikh, head of our US operations and is based out of our New York office, Kishore Joshi, head of our regulatory practice and is also a part of our funds formation practice. We have Prashant Prakhar, who is a senior member of the regulatory practice and is based out of our New Delhi office. Lastly, all participants are requested to put your phones on silent mode, and I request Nishchal to start the session, please. Thank you.
Thanks, Devanshi. Welcome to all the participants joining this webinar. We are living in unprecedented times. COVID has divided the world in two eras, before COVID and after COVID. As we know, the world before COVID used to be a globalized world where the corporations were willing to take risk for acquisitions abroad and expand in various geographies. What we are going to see post-COVID or what we call after COVID era, we are going to see reverse globalization happening where all the countries are going to protect the domestic companies and seal borders to ensure that the domestic industry flourishes and is not exposed to the risk of venturing abroad. What we are also going to see in post-COVID era is that a lot of corporations are going to become risk averse and focus more on their own geography as far as expansion is concerned. Already a lot of think tanks in the world have said that this year the world is going to experience a global recession where the global GDP is going to grow by not more than 1 to 1.5%. China is expected to grow at the rate of 2.7 to 3.2%. European Union is looking at a contraction of 0.5 to 1% GDP, and US is looking at a contraction of minus 0.5% to 0%. So clearly, the impact of COVID has been tremendous, and each and every economy in the world is going through a tough time. As far as India is concerned, COVID has been breaking all records. Today is a historic day in India because the Indian stock markets fell by almost 4,000 points, which is the highest ever in the history of India. The Indian rupee has fallen to 76 rupees for $1, which is again a highest that India has ever seen. So clearly, we are going through times which none of us on this webinar had ever thought that we will be experiencing this during our lifetime. As far as the industries are concerned, some of the industries which have been majorly hit in India, and it's the same thing in the world too, are hotel industry, travel and tourism industry, banking, and non-banking finance companies. We are going to see more non-performing assets coming out for the banking sector going forward, which is already facing tremendous pressure on account of falling GDP of India. The NBFCs are also going to go under further stress on account of the borrowers not being able to grow at the pace at which they had expected to grow because of COVID. However, there are certain industries and sectors which have remained unscathed by COVID. Two or three important sectors or industries which have remained unscathed are healthcare. It's obvious why healthcare sector is growing because we are talking about a disease, and the healthcare sector is doing extremely well on account of COVID. The other important sector which we see is going to flourish is health insurance sector, where we are going to see surge in the policies taken for health insurance going forward. We are also going to see uptick in sectors where internet and data is significantly used, because most of the people across the world and in India are working from home, and there is tremendous usage of data that's happening right now. Broadly, these are the sectors and the industries where we see opportunities as far as MNCs and private equity investors are concerned forward. A lot will depend on to what extent and how long COVID is there. Right now, it doesn't look like going to go away very easily. As we started in November and we are already in March, and it has started spreading across the world since last couple of months. So clearly, we haven't yet touched the bottom as far as the crisis is concerned. And what becomes important is in these times, how do we find opportunities for investment in India, and what type of structures that can be used for investment in some of the sectors which are going to do well post COVID. And the purpose of this session is to discuss some of these structures and the nuances for structuring some of these investments. So the reason why we thought it will be important to run some of these sessions is because as a law firm we believe that every crisis creates opportunities, and we should never waste a crisis, because crisis is the best time to reinvent ourselves. And what we thought is that as a law firm, since most of us are working from home, it might be a good opportunity for us to share our knowledge with the participants and our clients and channel partners, that we can make best use of the time, both for us and for the clients and the channel partners. So with this, I would request my colleague Vaibhav Parikh to share his thoughts on, from a US perspective, how are US companies looking at investing in India post-COVID era?
Thank you, Nishchal. Good morning, or good evening, good afternoon, wherever you are. I'm sitting in New York on Monday morning, where lockdown is just being effective from last evening. New York City, which is an epicenter of COVID-19 in the US. There has been a lot of thoughts and discussions on what it means for US and what it means for India. First of all, I think the people are still trying to fathom. In last few days, I had discussion with few of my private equity friends and few of my other industry people, and trying to see what it means for them. And what the first thing I hear from them is, look, I don't even know how long this is going to last. I don't even know how deep it will leave an impact on. But I know for one thing, the world, the way we have been doing business will completely change. What what I have heard is one, the over dependence on China will possibly go away. I mean, that's the discussion which we are seeing. Even when we thought that it was only contained in China, the supply chain disruption which it created, which created a lot of issues in all the sectors, including healthcare and including on essentials and stuff like that. There will be a change in the way the business looks at it. As Nishchal said, people will try to come back to nearshore, but I think India will benefit there because people will want an alternative to China, and this is something which was discussed, has been a discussion point for a long time, but recently we have seen this to be a more important aspect where you want to put, you don't want to put all your eggs in one basket. So to that extent, alternative to China in several industries, maybe some industry India will benefit. So I think that is one discussion, and that's when we talk to our private equity friends or some industry friends, they see that, hey, can I do something in India? If there's an opportunity because of this particular digression, then this is something which I would want to look at. Secondly, what we are seeing here is there has been forced adjustment on both working from home concept as well as trying to understand that how going in future, right, technology will help in addressing issues like this. So a lot of focuses will be on technologies. US is anyway leading, so US is excited on trying to use the newer technologies in the new post-COVID areas, and this is where there is a lot of opportunities in this. In other words, currently it's wait and watch, but definitely they are looking at opportunities post-COVID-19 and trying to see where in different era which they will live, where they will learn from this and have opportunities on investment. And India definitely figures as one aspect in this particular field. With that, Nishchal, I hand it back over to you. This is just what I'm seeing in New York and in the US, where we have offices, both in in Palo Alto in California and in New York City.
Thanks, Vaibhav. So let's deep dive into designing structures for foreign investments into India in the sectors which are going to remain unscathed or are going to do well going forward. And even for sectors which are not doing well, there is always an opportunity for distressed funds for the purpose of investing in some of those sectors. So typically, the way the Indian law works is from an exchange control perspective, there are certain regimes which have been allowed for the purpose of foreign investments into India. Primarily, there are three regimes which are there. The first one being the foreign direct investment regime, which is more for strategic acquisitions by multinational companies in India and for private equity funds looking at investing in growth businesses, and some of the venture capital funds looking at investing in startups and early stage companies. The second regime is foreign venture capital investor, which is a special regime for private equity funds where they are allowed to invest in Indian companies, but there are a lot of relaxations which are given to foreign venture capital investor entities, such as FVCIs are considered as qualified institutional buyers for the purpose of qualified institutional placements, and they can subscribe to securities in case of QIPs. FVCIs are not subject to any entry or exit pricing restrictions, which is applicable to FDI. FVCIs are not subject to lock-in post-IPO, which is applicable in case of normal in case of FDI investors. So there are multiple benefits which FACI entities have, which FDI entities don't have, and hence there is a separate regime which is there. The third important regime is foreign portfolio investor, which is more for hedge funds and funds which are investing in public markets, where they purchase and sell securities on the stock market. So broadly, these are the three regimes for investing in India. And depending on what type of investment you want to do, you can choose the right investment regime for investing in India. What we will do in today's session is we will go through some of the interesting nuances under Indian exchange control regulations for a foreign investor to invest in India. And just to give you some background, India as an economy has not yet made its currency fully convertible on capital account, which means that there are restrictions for foreign investors to invest in India. There is, for example, there are pricing restrictions. Same time, there are restrictions on taking out money from India. So while most of the things are relaxed, there are still certain restrictions which are there. But there are always solutions to get around some of those restrictions in a legal way. And that's what we are going to discuss today, so that the deal making becomes simple for the foreign investors. So let me take the first question and ask my colleague Kishore on, are there any pricing related issues when a foreign investor or an acquirer is looking at investing or acquiring any businesses or entities in India?
Yes. And as you said, a foreign investor, while investing into India, has to look at many aspects, including if there are any sectoral caps, or if it is under the automatic route or approval is required. In fact, in some of the cases, whether any license is required for any regulatory authority like SEBI, in case if they want to set up an investment advisory or banking entity, which instruments they should be investing into. But important, of course, from a foreign investor's perspective, when they are making investments under the foreign direct investment route, is of course these pricing norms. Because many foreign investors generally invest into an existing entities. So from that perspective, looking very briefly on the regulations as they stand today, if a foreign investor is setting up a new company in India in which he is subscribing to the memorandum of articles, naturally he can come without any pricing. He can invest at a face value. However, if he is making investment into an existing company, either by way of acquisition of shares from the resident sellers, or if the company itself is issuing fresh shares to this foreign investor, then of course the foreign investors has to comply with the pricing norms. And that is, first of all, the company has to make a valuation, its valuation of the equity instruments, and it has to be done by any internationally accepted pricing methodology. This has to be done either by a chartered accountant or a merchant banker or a cost accountant. And depending on what the fair price is arrived at as per the valuation, the foreign investors can invest a minimum of that price, and anything above that is possible, but definitely not below that. As against this, if there is a transfer of shares from a non-resident to a resident entity, in which case, of course, the money is coming into India, then the way pricing now works is that there is upper cap on which the foreign investors can make the investment. In the sense, he cannot expect price which is more than the valuation that has been arrived at. This is, of course, in respect of the unlisted companies. In respect of the listed companies, the Reserve Bank of India has prescribed that it should be as per the norms prescribed by the SEBI, that is the securities regulator, which, as we all know, in case of a preferential issue, SEBI has prescribed for the higher of the average to be taken of 26 weeks high and low and 2 weeks high and low from the relevant date. And the relevant date generally means the date on which the shareholders pass. Interestingly, Reserve Bank of India has done is, in many cases it so happens that when foreign investor is negotiating with the Indian promoters or Indian sellers, there are always certain, I would say, subject to fulfillment of which investors agrees to pay the full consideration. And naturally, there are certain, let's say, financials which they still have to look into upon after.
So Kishore, just to interrupt, what you basically said is that for a foreign investor to invest in India, there is a minimum price below which they cannot invest. And if they are to exit from India, then there is a ceiling beyond which they cannot exit. So, and that applies only in a situation where there is a transfer of shares of an Indian company from a foreign investor to an Indian resident, or from an Indian resident to a foreign investor, but it does not apply to a foreign investor to foreign investor situation. So non-resident or non-resident transfer pricing restrictions don't apply. And what I wanted to understand from you is there are a lot of M&A deals which happen where acquirers want working capital adjustments to happen, and the working capital adjustments typically happen post closing. Plus, there are also situations where acquirers want the founders to continue post sale, and founders are promised certain earnout based on the PAT or EBITDA of the Indian company. Plus, as we all know, there are always indemnities which the seller or the founders have to give as part of the sale. Now, in light of this pricing restriction which you mentioned, how do we accommodate the working capital adjustment, the indemnity payouts, and the deferred consideration earnouts? Can you throw light on that?
Yeah, sure. In fact, for this reason, Reserve Bank of India has in fact liberalized this pricing of the extent, and they have allowed what is called deferred consideration. So the way it works is that if a particular consideration has been finalized at the time of closing, you can defer 25% of this total consideration up to 18 months from the date the agreement is signed between the buyer and seller. 75% can be paid upfront. Now, it may so happen that this 25% of deferred consideration, either the foreign investor may not even pay to the seller, or if he wants to bring it into India to give a comfort to an Indian seller, an escrow account can be opened, and that 25% can be kept in an escrow. Or he can even pay the full consideration to the Indian seller, and the Indian seller can indemnify to the foreign buyer that 25% of the total consideration will be paid back. And that actually gives some kind of a comfort to the investors. But of course, all this payment which is to be done as far as 25% of deferred consideration concerned has to be done within 18 months from the date the agreement is signed between the buyer and the seller. There is one more thing, of course, in which generally these pricing norms don't apply, and that is when an Indian company wants to make a rights issue and a bonus issue. Under those circumstances, of course, the right is given to the Indian company that it can be at any price, but for an investor, than the price that is being offered to the resident investors. So maybe I think with all these that the investor has to look into, just a question, Nishchal, to you is that how to structure the foreign investments in India within this existing framework. If you can just throw some light on that.
Just before that, Kishore, we have a question from one of the participants on, is it possible to have a liquidation preference right for non-resident investor under FEMA, given that liquidation preference attributes higher value to non-resident shareholders? So the answer to this is it depends on the capital structure of the company. So if the non-resident shareholder has significant number of, let's say, compulsorily convertible preference shares, and it is possible to convert the compulsorily convertible preference shares into equity at a very low rate, such that higher number of equity shares are can in, and the shareholding is
Nishchal,
adjusted in
sorry.
a manner. So if there are convertible instruments which can be converted into equity at a lower valuation, such that the higher shareholding can be attributed to the converted equity shares, in that situation, it is possible to achieve the liquidation preference right. And liquidation preference does not necessarily mean that only the company is going to distribute proceeds to the shareholder. Liquidation preference also sometimes can be structured in the form of secondary, where all the shareholders of the company are selling, and certain shareholders who are not eligible for liquidation preference, they take some hit on the valuation. Obviously, at that time, some of the tax issues will have to be looked into as to whether the valuation at which the shareholders who are not getting liquidation preference they are transferring, is it below the book value or above the book value, because otherwise Section 56 of Income Tax Act can get triggered. But otherwise, it is possible to structure liquidation preference right in case of a secondary sale. If it's a primary transaction, and if it's a distribution of proceeds by an Indian company to its shareholders, and all the shareholders are holding the same class of shares, then obviously it is not possible to buy back or do a capital reduction for certain class of shareholders. Uh, uh, because of in a situation where other shareholders are not acting in a friendly manner. But if, let's say, instead of investing under foreign direct investment route, if the a foreign shareholder is investing under the foreign venture capital investor route, then there is a lot of flexibility on pricing and some of those aspects which are not applicable to which are not available with FDI investors. So for example, a foreign venture capital investor can also invest in an optionally convertible instrument which can also be redeemed. And then when you have such instruments which can be easily redeemed, it is possible to achieve liquidation preference, because you can just first redeem that instrument before touching the common equity shares which are held by all the shareholders. And because there are no pricing guidelines or applicable with respect to the returns that can be paid on those instruments, it is possible to achieve the liquidation preference right. So just moving on to Kishore's question on how do we structure investments into India. So broadly, what I told you at the beginning of the session, there are three regimes: FDI, FVCI, and FPI regimes. And especially when the client is a private equity fund, we always advise the client to set up all three vehicles, because in India, given the complex regulatory and tax environment, what always happens is you never know which vehicle or which regime will be helpful in which situation. So there have been situations where, just because all three vehicles were ready, FDI, FEC, and FPI, there was a client who was able to do the deal, which some of the other bidders who did not have one out of the three vehicles not ready and available, they could not bid for the deal. So what's extremely important is have your structure ready with all three types of entities, so that you can use either of the entities to make investment. So just to give an example, it might happen that a listed company opportunity comes up, and in that listed company, there is a requirement to acquire shares on the floor of the exchange. That's something which an FDI investor cannot do, but an FPI investor do. Similarly, there could also be an opportunity where a debt needs to be provided to the Indian company as part of the deal. The second situation could be, it might happen that the Indian company needs debt. And what could happen is, in that situation, FDI investor cannot give a debt which is redeemable, because FDI investors can only invest in equity or instruments which are compulsorily convertible into equity. But if you have an FVCI vehicle, you can actually invest in non-convertible debentures or optionally convertible debentures of Indian company. Or even a foreign portfolio investor can invest in listed or unlisted non-convertible debentures of the portfolio company. So having all three vehicles gives a lot of flexibility. And now one more vehicle which is becoming very popular for investing in India is in AIF, Alternative Investment Fund. It's an Indian vehicle which is used for the purpose of investing in India. And there is a lot of structuring flexibility that that vehicle creates for the purpose of investing in India. So this was as far as the guidelines are concerned. From a jurisdiction perspective, India has changed a lot as far as the intermediate jurisdiction is concerned. Prior to March 31st, 2017, Mauritius and Singapore and Netherlands used to be the favorite jurisdiction for international investors to invest in India. However, post the treaty benefits being taken away for Mauritius, Singapore, we are seeing more and more investors also preferring to invest from their local jurisdictions like US. So, for example, if only equity shares is something that the foreign entity is going to invest in Indian company, then whether you invest through Mauritius or you invest directly from US, there will be a tax, capital gains tax of 10% that will be applicable. And we have seen some of the investors not willing to take on the burden of setting up structures in Mauritius and Singapore because of the cost issues, dealing with the administrators, and some of those issues coming up. So while there is also a class of investors who want to invest directly, there is another class which still wants to stick to Singapore and Mauritius from a structuring flexibility perspective, so that it is easy for them to restructure their operations at Mauritius or Singapore level and without touching the Indian entity. So we have seen both types of situation. As far as equity is concerned, as I mentioned, jurisdictions are agnostic. But if the investment strategy is to invest in debt, then we are seeing Mauritius being used a lot, given that the withholding tax rate has got reduced to 7.5% of when Indian company pays coupon to a Mauritius entity, which is 15% in Singapore and 10% in Netherlands. So if debt is the strategy, then use of intermediate jurisdiction still makes sense. But for equity, as I mentioned, direct investment is also something that we are seeing. So since we are talking about instruments, Prashant, I think it would be useful if you can talk through what are the instruments which can be used for investing in Indian entities.
Understood. So, as you mentioned in the beginning, so there are these three primary regimes that a non-resident looks after when it comes to making investments into India. So let me divide the types of instruments through which the investment could be made as per these different regimes that are available. So when it comes to making investments under foreign direct investment route, there are four different types of instruments that can be used for making these investments, and together these instruments are called as equity instruments within the exchange control framework. And these comprise of equity shares, compulsorily convertible preference shares, compulsorily convertible debentures, and share warrants. Now, what is important to be remembered is that with respect to preference shares and debentures, they have to be compulsorily convertible, and the conversion ratio of these instruments would have to be decided upfront when those instruments are being used as an instrument for investments into India under the FDI route. Now, so this is with respect to a company when a company seeks investments under the FDI route. Now, when it comes to an LLP, which is a limited liability partnership, when they seek investments under the FDI route, it could be only in form of capital contribution in that LLP. And there are not enough scope available to sort of innovate in terms of different instruments with respect to an LLP for seeking these investments under the FDI route. Moving on to the FVCI route, where there are certain benefits associated in terms of no pricing restrictions being there. There are some restrictions also in terms of the sectors in which those investments can be made. So an FVCI is allowed to make investments only in 10 specified sectors, which include sectors like biotechnology, nanotechnology, poultry, dairy, infrastructure, etc. And when investments are being made in a selected sector, government has given the leeway to be able to invest in instruments which are beyond what is allowed under FDI route, and therefore the provisions as it stands today, one can invest in all forms of securities which is permitted under the Indian regulations for a company to issue. That is with respect to a company. Beyond a company, investments under FVCI route can also be made in venture capital funds or units issued by a Category 1 AIF. As you know, Category 1 AIF are a category of AIFs which are there for a purpose, and their focus is mostly towards sectors that require more push in order to flourish. And then comes the third option that is available to FVCIs in terms of making investment. That is any equity linked instrument or debt instruments which are being issued by startup entities. Now, these startup entities would have to be recognized as a startup by DPIIT under its framework, which sort of has certain eligibility criteria in terms of 7 years post incorporation, they not having a financial turnover of more than 25 crores over those period, and some additional requirements in terms of their business. It has to be an innovative business model, and then something that will require from the perspective of giving a boost to their business. That is where the startups can sort of seek investments under the FVCI route. Then comes the third route of investment, which is foreign portfolio investment, which is primarily for investing into listed securities. But over the years, there have been some relaxation where some unlisted securities have also been included, and because of which it is one of the preferred routes also for making such investments. In terms of listed instruments, equity shares which are issued by companies and listed on stock exchanges can be traded through FPI vehicle. The unlisted ones would include commercial papers, non-convertible debentures issued by unlisted companies, or units being issued by it won't be a unlisted instrument, but units issued by exchange traded funds, who is also somewhere where FPIs can invest. And besides this, there is a whole lot of laundry list that has been prescribed under the FPI regulations, where a FPI can invest in terms of the instruments where it is allowed to invest. And we talked about these. I guess, Nishchal, there's one more point I wanted to cover. This is with respect to investment vehicles. So when I talked initially about foreign direct investments being made, one, I talked about the company. Second, I talked about the LLPs. Third is the investment vehicle structure. And as Nishchal had rightly pointed out, this is one vehicle that is becoming very popular these days, given the structuring benefits that are associated to it. And investment vehicle is a very broad term within the regulations. It has been defined to include all such entities that may be regulated by SEBI under its regulations. However, there is an indicative list that has been prescribed, which includes AIFs, REITs, InvITs, and mutual funds. With respect to mutual funds, it only includes those mutual funds that have more than 50% of their investments into equity instruments. And so when it comes to making investments into these investment vehicles, one also has the option to subscribe to the units being issued by these investment vehicles. Over to you, Nishchal.
Thanks, Prashant. There are a few questions which have been received, so maybe we can just take a couple of questions. The first question is, would contingent consideration be considered as part of deferred consideration for the purpose of 25%? So there the answer is yes, whether it's a contingent consideration or a fixed consideration which is just deferred, it has to be within the 25% limit of the total consideration. So just to give you an example, if $75 is a upfront consideration, then the contingent consideration or deferred consideration or post-closing working capital adjustment, all this combined cannot exceed $25, which means $25 plus $75, which is the upfront payment, will be considered as the total consideration, and 25 on 100 is 25%. So that's the maximum that is permitted for the purpose of deferred consideration, indemnity, and working capital adjustment without approaching government for any approval. So this is all available under automatic route. The second question which has come up is for the purpose of pooling vehicle which may invest in AIF in India, do you think FECI still makes sense? The answer to this is, as far as AIF is concerned, whether the foreign investor is an FDI or an FECI entity, it shouldn't ideally matter, because it all depends on whether AIF is a domestically owned AIF or not. If the manager or the sponsor of the AIF is domestic owned or controlled, then in that situation, AIF investment will be considered domestic, in which case it doesn't matter whether FECI is investing or not. If it is foreign owned or controlled AIF, then because FECI is not directly investing in India and it is investing through AIF, it is not necessary that it will directly get the benefit of FECI regime. And there will be a special dispensation that will have to be sought in case that foreign owned or controlled AIF wants to get the benefit of FECI. There is one more question which is there. Can the same vehicle have flexibility to invest via all three routes, FDI, FPI, or FECI? The answer to this is technically and legally yes. It's possible for the same vehicle to invest under three regimes. Only thing is, some of the AD banks have and custodians have created certain issues recently, where they have been asking that they want separate vehicles to be there for each of the three regimes, and not mix the vehicles or not mix the regimes and just have one vehicle. So legally the answer is yes, but you'll have to just ensure that the ADs and custodians are also on the same page. My next question goes to Kishore on the pledge of shares by a foreign investor. Typically, what we have seen is the MNCs, global MNCs, which have subsidiaries in India, for borrowing by their Indian subsidiaries from local banks or NBFCs, they need to pledge their shares that they hold in their Indian subsidiaries. The question is pledging of shares as a concept under automatic route, or is there a requirement to seek government approval?
Yes, while of course most of the regulations in respect of transfer of shares prescribed by RBI under the general permission are either by way of sale or by way of gift, and considering that pledge is also one of the transfers considered under the FEMA, what Reserve Bank of India has done is, while of course earlier they used to insist for prior approval for any kind of a pledge to be made by the foreign investor, they have prescribed certain relaxations. I would just split those into two. One, of course, is there is a promoter of an important Indian company is raising an external commercial borrowing. Under those circumstances, the promoters are allowed to pledge the shares so that the Indian borrower company can raise funds. Of course, subject to certain conditions, that is, the money being raised has to be used for the same end-use purpose as prescribed under the ECB regulations. The statutory auditor has to provide a certificate to that effect. And the other scenario where the shares can be pledged is by any person resident outside India is allowed to pledge the shares of an Indian company. And these shares are pledged in favor of an Indian bank to provide the credit facility to the Indian company, that is allowed under the automatic route. In case if the shares are to be pledged to an overseas bank to provide credit facility to the said shareholders, that too is allowed under the general permission. The same way, even they can pledge the shares to an Indian non-banking finance company also to provide facility to Indian company. The only important point that needs to be kept in mind is that in case of invocation of the pledge, naturally you have to take into account the sectoral caps or the pricing guidelines or any other conditions that are to be met, because it would be a transfer from the existing shareholder who has placed the shares to the lender. So to that extent, at least some kind of the relaxation has been provided by RBI.
Thanks, Kishore. There are a couple of questions which have come. Maybe I'll just take it up. I think one question is, can an FPI invest in unlisted shares? As we mentioned, FPI regime was created for the purpose of investing in listed securities. So FPIs are currently allowed to invest in listed and to be listed securities. Unlisted shares is something that's not allowed under the regulations for the FPIs to invest. However, FPIs can invest in unlisted debentures issued by an Indian company, subject to satisfaction of certain end-use conditions. So that's the answer as far as FPIs being allowed to invest in unlisted shares. There was one relaxation.
Just one small point initially is that, of course, the said FPI entity can, under the foreign direct investment route, can make investment.
Absolutely. So FPI under FPI regime can only invest in listed or to be listed security. But as we discussed, if the same entity has the flexibility to invest under multiple regimes, then the same FPI entity can invest under FDI regime also, in which case there won't be any restriction for FPI entity to even invest in unlisted securities or unlisted companies. There is one more question. It's a long one, but what I understand is if a foreign investor wants to provide guarantee of X% to a domestic financial institution, and domestic financial institution will lend to its Indian business or Indian subsidiary. Is this something which is possible? And under which regime will this fit into? So what essentially this means is there is an Indian lender which is lending to Indian subsidiary or Indian investee company of a foreign investor, and foreign investor is giving guarantee to the Indian lender or financial institution. The regime under which this will fall is ECB structured obligations and guarantees. And there it is possible for a foreign investor to give a guarantee to the Indian lender. So the point is that in a situation where a guarantee is given and guarantee is invoked, then the foreign investor will pay this money to the Indian financial institution or the lender, and the foreign investor will then have a recoverable or receivable from the Indian borrower, since it discharged the Indian borrower's obligation towards the Indian financial institution. And that recoverable or receivable will also be under automatic route without any need for any approval from the regulator. So this is covered under structured obligations. It's part of the ECB regulation circular. The next question is to Prashant. Prashant, we have been hearing from various from the regulator that if there is an Indian company which is held by a foreign investor, then that Indian company will also have to comply with certain downstream investment requirements. Can you please throw some light on that?
So the concept of downstream investment is basically based on the principle of what you can do directly can be done indirectly. What you cannot do directly is something that you cannot do indirectly either. So when an Indian entity which is owned and controlled by non-residents makes investments into another entity, that is regarded as downstream investments as per the definition under the Indian regulations. And this could be true in the case of a company or a LLP or an investment vehicle making downstream investments into their portfolio companies or subsidiaries. Now, when it comes to making these downstream investments, while of course it is a foreign owned and controlled entity, despite being an Indian entity making these investments, what is important is that these investments must be made out of the funds which have been brought from abroad, or it is being made out of the internal accruals of the entity that is making this downstream investment. What do I mean by internal accrual? It means the profits of the entity which has been kept in reserve after having paid the applicable taxes on that. And it is also to be kept in mind that no borrowings are allowed for the purposes of downstream investment. So you cannot take leverage from Indian financial institution and then use that money for making investments into the downstream entity that you are thinking of making investments into. So once you have made downstream investments, there are certain reportings that are required to be done, and these reportings are twofold. One, you have to, make a reporting to the Reserve Bank of India saying that you've made downstream investment, and you'd have to basically file Form DI with respect to that. Whereas there is a separate reporting that you would be required to do to DPIIT through Foreign Investment and Facilitation Portal. And the reason why all of this is required to be done is because the concept of downstream investment is also, it is also called as indirect foreign investment. So even though it is not a foreign entity that making direct investments into India, it is an Indian entity that is controlled and owned by a foreign resident, and therefore the color of the money is treated to be a foreign money. And that's the idea behind downstream investments being treated as indirect foreign investment, and all the attendant conditions which are otherwise applicable on foreign direct investments sort of also applies to downstream investment. Now, what does that mean for downstream investment? Is that this, when I say these conditions which are applicable on FDI are also applicable to downstream investment, it means that the sectors in which you are investing, you have to be mindful of the sectoral limits that are applicable on them. You may also have to be mindful of the pricing restrictions given the party with whom you would be entering into a transaction with. If, say, for whatever reasons you are an FOCC, and if you are entering into a transaction with a resident Indian, then you may have to comply with the pricing requirements as well. Whereas if as an FOCC you are entering into a transaction with a non-resident, there may not be a pricing restriction, but there may be reporting requirements that may be applicable to you. So, and I guess this is the primary reason why when downstream investments are brought into question, the authorities are a bit wary of the transactions that they are entering into.
Thanks, Prashant. I think one of the biggest structuring avenue which opened up a few years back was when government allowed AIFs, which are Indian owned and controlled, to be considered as domestic entities, in spite of the fact that majority of the investment would still come from foreign sources. So there have been situations where more than 80 to 90% of investment is foreign in the Indian AIF, but because the Indian AIF is owned and controlled by manager, which is owned and controlled by Indian residents, the investment by that AIF is considered as domestic investment. So clearly the structuring avenues have opened up substantially after the AIF structure was allowed by the government. And we have seen number of interesting deals which we have advised on for the clients, which were not possible earlier before AIF as a structure was possible to be used by foreign investors. We have got few follow-up questions. The first question is, if an FPI invest in a pre-IPO, and this is from Sandeep Maheshwari, will that be considered as a to be listed, or do they need FDI route eligibility? The answer to that is, for any situation to be considered to be listed, typically we apply the benchmark of filing of DRHP with SEBI. Once that DRHP is filed, then view can be taken that it's a to be listed security. The second is in case there is a reverse merger happening where a listed company is merging with unlisted company, and by virtue of the merger, the unlisted company is going to get listed without an IPO. In that situation, the day you file the scheme with NCLT, it will be considered as the day purpose of trigger of to be listed situation. There is another question which has come, which is whether acquisition of shares of an Indian company by a foreign owned or controlled entity from an Indian resident would be subject to deferred consideration regulations explained earlier. Say 50% of consideration can be deferred in such a transaction for a period beyond 20 months. So the question is, while the restriction is for a foreign investor, for deferred consideration where 25% as a concept is allowed. Whether the concept will apply to FOCC, foreign owned or controlled company. I think earlier the way FOCC or downstream investment regulations were worded, there were only three requirements that were required to be satisfied by FOCC. One was on pricing, second was on sectoral gaps, and third was on conditionalities. As long as these three requirements were satisfied, FOCC was considered to be complying with foreign investment regulations. Now, in the since DISPRO was introduced in 2017 and even the latest FEMA non-debt rules of 2019, there is also a language which has been added and attendant and other conditionalities for foreign investment. So while it has not been tested, given that in addition to the previous three restrictions which were there under the earlier law, since other conditions under foreign investment applicable to foreign investment have also been added, it will be difficult to take a view that some of the restrictions such as deferred consideration and 25% will not be applicable in case of an FOCC. But as I mentioned, it's not something that has been tried and tested yet. Another question which has come up is, and this is the last question since we need to close at 7 p.m. India time. If an AIF manager and sponsor are Indian owned and controlled, and AIF pools money is 100% from non-residents, can such AIF can invest in multi-brand retail sector, which is highly regulated under FEMA without triggering FEMA restrictions. Okay, so strictly speaking, the legal clinical view here is that once the Indian AIF is Indian owned and controlled, it loses the character of any investment done by that AIF loses the character of foreign investment, and it can pretty much invest in any sector just like any other domestic investor. Having said that, for sensitive sectors, which I would say which are prohibited under exchange control regulations for foreign investors, it is better from a smell test perspective to stay away from these structures. As far as multi-brand retail sector is concerned, it's not something which is completely prohibited, but that's something which it all depends on the amount of investment that needs to be taken, whether it's a minority deal, majority deal. If you are going to do a control transaction through AIF, then I would think twice before suggesting the structure. If it's a minority investment, then that's something that can be explored through an AIF. So with this, we have we are concluding our session.